Good morning and welcome
to the Business Standard Morning Show,
a show that resonates with millions of viewers.
watch the best of business news only on
The Business Standard Morning Show. Good morning and welcome to the 200th episode of the Business Standard Morning Show. This milestone offers us a chance to thank our viewers for their tremendous support. A total of 1 crore 8 lakh views says a lot about the popularity and the quality of the show, where we have been offering in-depth analysis of every event which mattered in the world of business and economy. So, don't forget to tune in to the show every morning at 8 to stay informed and stay ahead. With that, let's move on to today's show. Here's a look at the stories.
What the world needs now is people who see energy a little bit differently. Because seeing a more sustainable world isn't far in the future. We're building it now. GE, building a world that works.
We always took them for granted. They were the sidekicks in Tetra packs, glued somewhere on the back. But suddenly the humble straw has taken the center stage. If the government doesn't relax its July 1 deadline to phase out single-use plastic from the country, you are going to miss the straws badly. And so will FMCG companies, which are now scrambling to find a replacement, their paper version. Our next report offers an insight into the world of plastic straws and tells why small packs of your favorite box juice might disappear from markets for now.
The impending ban on single-use plastics will deal a death blow to the humble straws from July 1st, and it has left FMCG companies selling small packs of juices and dairy products in a tizzy. With just a week to go for the ban to come into effect, intense lobbying is still underway by some stakeholders to get the deadline extended. Every year, 6 billion small packs between the sizes of 75 to 250 ml with juice, milk, coffee, buttermilk, lassi and other beverages are sold with plastic straws attached to them, a market that is estimated to be worth 6,000 crore rupees. Such integrated plastic straws account for just 0.05% of the total single-use plastic in terms of volumes. Yet, the stark reality is that plastic straws take up to 200 years to decompose, and they break into smaller plastics and can be ingested in marine life. In contrast, paper straws decompose within 2 to 6 weeks. The companies that are impacted most are the big ones like Coca-Cola, PepsiCo, Parle Agro and Dabur India. Their concern is that India does not produce the required paper straws. Action Alliance for Recycling Beverage Cartons or AARC, an industry group that represents some of the major beverage producers, had demanded that plastic straws be exempted from the ban on single-use plastics from next month, but changed its stance in May. Still, it sought an extension of 18 months for the transition. Most consumers are familiar with the experience of using paper straws for cold coffees or milkshakes. They become soggy even before the drink is over. So making resilient paper straws of smaller diameters is another challenge. Companies are compelled to import paper straws, which are 4 to 7 times more expensive than their food-grade plastic counterparts. Frooti and Appy maker Parle Agro CEO Shauna Chauhan said that extending the deadline by 6 months was critical for developing local manufacturing capacities. While the company has started importing paper straws for now, she said it is an unsustainable option and the economics just does not match up for a 10 rupee product. She said that 80% of integrated straws are recycled and countries like China and Thailand have allowed their use. Chauhan further said it was not clear what would happen to the current stocks if the ban was enforced. Dairy giant Amul, which clocked sales of 61,000 crore rupees in FY22, also urged the government to delay the ban by 1 year, saying the move will have a negative impact on farmers and milk consumption, while also warning of sales disruptions. Citing global capacity constraints and logistical drawbacks, Parle Agro warned that the industry might have to close factory operations if the deadline is not extended. There is a global shortage of paper straws. Only China, Indonesia and some European countries make them, and India comes low on their priority list. And for those who are trying to import machines to make paper straws locally, it is a 1-year wait. The CEO of AARC, Praveen Agarwal, estimates that imports can meet only 25% of the country's demand by this year's end. Can companies choose to ship the products without a straw or change the packaging to spout pouches instead?
Yes, there is going to be massive disruption from 1st July. In case the industry does not get the transition time, the consumers are going to face certain hardship. The retailers, distributors, everybody is going to face a lot of difficulties in removing the stock from the shelves as well. Companies are trying very hard to replace integrated plastic straws with either domestically manufactured paper straws or imported paper straws or even compostable plastic straws. Having said that, changing the packaging design is time consuming and long process. It's also a very costly process. On top of that, for products priced at 5, 8, 10, 15 rupees, we also have to look at packages which provide comfort, economy and convenience to the consumers, which many other alternative packaging formats may not allow. Shipping the products without straw, of course, is a possibility, but is not the preferred alternative at all. As the consumer is going to be inconvenienced, the safety and hygiene aspect of the package is likely to get compromised.
Environmentalists, on the other hand, argue that ample time has been given to the industry to find the appropriate substitutes for plastic straws. The phasing out of these straws was initially notified by the Central Pollution Control Board way back in 2018, fixing 2020 as the deadline for doing so. The present deadline of July 1 was set almost a year ago in August 2021. Compostable straws made of paper and cornstarch-based polylactic acid are now being commonly used in many other countries. Nestle India has already started attaching imported paper straws with its cold coffee packs and Milo range of products. Despite months of lobbying, the government has not relented, and it is not expected to either, since such plastic straws are only one of the 22 single-use plastic products that are banned from July.
The entire industry, the vendors have been working on the alternative solutions for few years. These innovations and solutions take much longer than a few months. For instance, the process of identifying the right molecule for manufacturing compostable plastic straws, that's again very tedious research and development effort. And once this molecule has been tested, it has to undergo validation from regulatory authorities. And we still believe that government will respect industry's concerns and find some solution.
An Indian packaging company is setting up a plant with technology from the Netherlands that will be able to meet the entire domestic demand of paper straws by the peak season next year. Until then, FMCG players hope the government will heed their last-minute demand as they stare at disruption in supply of juices and drinks with the ban nearing.
सब अच्छी दिख रही हैं यार, कौन सी खरीदूं?
ये तो वही बात हुई, 4000 शेयर्स लिस्टेड है, कौन सा लूं?
वो तो सबसे आसान है।
तुझे 5 पैसा नहीं पता?
अब तो सबको पता है। 5 पैसा पर है 4000 स्टॉक्स की रिसर्च, टेक्निकल टूल्स और इन्वेस्टमेंट आइडियाज। डाउनलोड 5 पैसा नाउ।
अब तो सबको पता है, investing made easy and rewarding with 5 paisa. Investments in securities market are subject to market risks. Read all the related documents carefully before investing.
Meanwhile, let's turn our focus to a case which might turn out to be a straw in the wind. A labour court in Chennai recently asked IT giant Tata Consultancy Services to reinstate a former employee and clear all his past dues of 7 years. Some experts believe that this case could become a reference point in performance-related unlawful termination in the IT industry. Let's find out more about it in our next segment. Tirumalai Selvan Shanmugam was told to leave TCS in 2015. The reason cited for his termination was underperformance. But Shanmugam wasn't convinced. He moved the labour court in Chennai against the IT giant, seeking reinstatement. And after 7 years of trial, he got what he wanted. Principal Labour Court in Chennai directed TCS to reinstate Shanmugam. This case might have some long-term effect. It shows that unions and workers are evolving in the new setup and asserting their rights in IT companies too. And as a result, the IT firms could face greater pushback from employees in future cases of performance-related or large-scale terminations. In setting aside Shanmugam's termination, the Chennai court did not accept the IT giant's argument that he was not covered under the Industrial Disputes Act's workman definition because his role had been supervisory in nature. A legal expert told a financial daily that the Shanmugam ruling suggests that employees of IT companies are not automatically exempt from the purview of the Industrial Disputes Act. Another legal expert said that the law has quite a wide definition of workman. This definition does not change under the new labour codes, and exclusions to this definition are also limited.
The judgment gives two important. It answers two things. One is earlier, all the IT employees fall under managerial category. It's not like that. Based on their work nature, it will be decided. It has clear argument, everything it mentioned that the person, working for the development or, the software testing or development, he is a employee, like worker category only. And another thing is the long, even though it's a long wait, we got the answer, like we will get all the salary back and we will get this job back. So this reinstatement judgment gives more strength to us. We resolved so many issues. Now there are so many cases are going on in multiple cities like Chennai, Bangalore, Pune, and Kolkata. So it's going on. So the number is like already, I think, like we might have crossed more than 1,000 cases already all over India, and many success history we have.
TCS and the other companies should rethink. Especially, there are certain things which they have been looking at, and if you look at the bell curve, which has been there previously, has been reimagined before. Now, this particular case has been a bit older case, so it is not appropriate to benchmark the situation which we have today with the situation which we have few years back. But having said so, I would say that, there is always an opportunity to rethink and relook from a larger interest of employees in the organization and see that it should not negatively impact, or it should not create any such situations from a legal perspective. And I am sure that the IT industry will think, and especially when in this kind of a scenario where demand and supply gap is huge, and this kind of news doesn't positively contribute to the overall situation.
At present, the IT industry is more concerned with incredibly high attrition rates. Retaining talent is the topmost priority. However, there are many who have not forgotten the mass layoffs seen in the past decade. In 2021, the Indian IT sector employed around 16 million workers. As recently as June last year, the National Association of Software and Services Companies had to allay fears of job losses in the IT sector. In response to a report projecting mass IT job losses, the IT industry body had said that the sector would continue to be a net hirer of skilled talent and that the top 5 IT firms had plans to add over 96,000 employees during FY22. A Bank of America report had said that with automation taking place at a much faster pace across industries, Indian software firms would slash jobs by a massive 3 million by 2022. So going forward, this Chennai court ruling, combined with the upcoming labor codes, will make the employees' position in IT companies much stronger. It will also force IT firms to improve their handling of performance-related exits or mass layoffs in a better way.
यार
मत पूछ यार, फिर से स्टॉक्स में फंस गया।
तो स्टॉक्स के साथ बॉन्ड्स, इंश्योरेंस, गोल्ड में बैलेंस कर।
इसमें बहुत तामझाम है।
तुझे 5 पैसा नहीं पता?
अब तो सबको पता है। 5 पैसा है ऑल इन वन अकाउंट। डाउनलोड 5 पैसा नाउ।
अब तो सबको पता है। Investing made easy and rewarding with 5 paisa. Investments in securities market are subject to market risks. Read all the related documents carefully before investing.
After the labour laws, let's move on to markets. Will the policy makers, in a move to catch up with reality and surging inflation, may overdo things and cause much more damage to the economy and markets than what is needed? Will the next 6 months be even more painful for the Indian economy and markets? Business Standard's Puneet Wadhwa caught up with Nilesh Shah, Group President and MD, Kotak Mahindra AMC, on his interpretation of the developments and how investors should approach the markets.
In a move to catch up with reality and surging inflation may overdo things and cause much more damage to the economy and markets than what's needed?
So it's always easy to judge in the hindsight. But I do believe this film will be in 2 parts. First part where policymakers will tighten liquidity, raise interest rates, control demand or reduce demand in order to control inflation. And then there will be a brief intermission. In the second half, the same regulators will probably take steps to support growth. Now, it could be again combination of same steps, cutting down rates, providing liquidity, providing stimulus. So there will be undoubtedly 2 phases, 2 cycles. We just have to hope and pray that regulators exactly know to take the step out of the pedal.
The sell-off that we have seen in equity markets across the globe could actually be in 2 phases.
No.
Or could the second phase be, more of a relief rally from that the first step is over?
Absolutely. Equity market always moves in anticipation. So right now they are discounting the first half of the movie because they don't know where this movie is going to have an intermission. So today they are pricing in tightening liquidity, lower interest rates, slowing growth, reduction in demand, in some countries even recession. But the same markets over a period of time, once they realize that central bankers will be back to the growth support, then they'll start discounting, increasing liquidity, falling interest rates, pro-growth measures. But we don't know how long the first half of the movie is going to last.
On a scale of 1 to 10, 1 actually being the biggest spot of bother, how would you rate the Indian economy, let's say 6 months ago and now? Do you think that the next 6 months will be even more painful for the Indian economy and markets?
So undoubtedly today we are oasis in the desert. Undoubtedly our Rahu Kalam has started as oil prices have gone up. Right now we are seeing triple-digit oil prices, higher inflation, FPI outflows, and clearly growth will be taking a hit. If 6 months down the line, we have one scenario where Russia, Ukraine is settled out, oil prices are in double digit, globally central bankers have controlled inflation and are now taking steps to support growth, we will be in a far better situation. On the other hand, if the situation continues to deteriorate, Russia has escalated Ukraine situation, central bankers haven't controlled inflation and they are still in tightening mode, and central governments are not taking pro-growth steps in order to control inflation, then we could be in a serious situation than what we are today.
There was a time when diversification into other geographies and markets was being advocated to investors to catch the rising stars globally. Then there was this Kotak Global Innovation Fund that has seen some negative return over the past since inception, about 39-40%. So what went wrong here? One, two is that do you still advocate investing into other geographies, given the way markets are, given the way US indices have performed, and given the way Europe is actually doing?
So we advocated allocation in offshore assets to diversify your portfolio. Since we don't know how to manage this funds, this stocks or this markets, we tied up with whom we thought is one of the finest in the craft. We tied up with Wellington Asset Management. They manage more than $1 trillion. They are in existence for almost 100 years. They are investment manager of repute. This fund was launched in somewhere middle of 2021. And thereafter, a series of events have happened which we had not anticipated at the time of launch. Immediately after launch, China cracked down on its technology stocks. Their index came down by 70%. No one had anticipated that because valuation-wise Chinese tech companies were doing reasonably well. But the whole business model shifted from profit to charity. The second thing that happened in this set of companies was US interest rates and inflation. Suddenly, the companies which were loss-making or which were dependent upon external capital got derated significantly. The third thing which happened was when markets become attractive to invest into, there was a cap on the overseas investment limit. So we couldn't even tell people to average into Global Innovation Fund. Now, yesterday, SEBI has announced some relaxation. Our recommendation to investor is that treat Global Innovation Fund as a high-risk, high-return fund. It gives you diversification into overseas companies which are generally not present in India. As I mentioned now, since they have corrected a lot, the valuations have become far more reasonable. If your risk appetite permits, this is the time to average into global innovation. We tried what was humanly possible in our capabilities to provide a better product to our investors. Unfortunately, for the last almost a year since it is launched, it hasn't worked well for investors.
Thank you, Nilesh, for your time today. We sincerely hope that the Rahu Kal for the markets and the economy ends soon. We hope to see you soon.
तुम इतना गिर गए? अब क्या किया?
शेयर्स में ट्रेडिंग।
तुम्हें 5 पैसा नहीं पता?
ओए, अब तो सबको पता है। 5 पैसा पर मिलते हैं रिसर्च टूल्स, पोर्टफोलियो एनालिटिक्स और इन्वेस्टमेंट आइडियाज भी। डाउनलोड 5 पैसा नाउ।
अब तो सबको पता है Investing made easy and reporting with 5 paisa. Investments in securities market are subject to market risks. Read all the related documents carefully before investing.
Like the markets, some dark clouds of uncertainty are hanging above the country's economy too. But beams of sunlight shining through the cracks are offering hope too. That good days are ahead. The Finance Ministry recently said that India is at low risk of stagflation. But it also cautioned about a twin deficit problem that the country may face. Our next report tells more about it.
The Russian invasion of Ukraine entered its 119th day on Wednesday. The epicenters of the war are in tatters and casualties mounting. But beyond the borders of the region, countries are engaged in a different kind of war to save their economies. Crude oil prices are hovering above $100 a barrel for a while. Supply chain is disrupted. Inflation in most countries is above their comfort level, and the world's largest economy, the US, is staring at recession. India too couldn't remain untouched. The country's finance ministry, in its recent monthly economic review, has struck a note of caution on the twin deficit problem, which is an increase in both fiscal deficit and the current account deficit at the same time. But before we explain what it could mean for the economy, let us have a brief look at these two deficits. What is fiscal deficit? In simple terms, fiscal deficit is a scenario where the government spends more money than the revenue it gets. The government fills this void by borrowing, mostly from the markets. What is current account deficit? A current account deficit is the shortfall between the money received by selling products to other countries and the money spent to buy goods and services from other nations. So what happens when the twin deficit problem strikes, and why we may be staring at it? The Ukraine war has led to the supply shortages, leading to higher commodity prices and increased subsidy burden on the government. Adding to that, the duty cuts on petrol and diesel mean the government may have to forego 85,000 crore rupees in revenue for the current fiscal. As the war lingers, there is every chance the government may miss the fiscal deficit target for FY23, which is 6.9% of GDP. The increase in the fiscal deficit may cause the current account deficit to widen. The twin deficit problem, especially the worsening current account deficit, may compound the effect of costlier imports and weaken the value of the rupee, thereby further aggravating external imbalances. This creates the risk, even though admittedly low at this point of time, of a cycle of wider deficits and a weaker currency.
I'm backed by the nation's trusted bank, SBI, the banker to every Indian.
China, on the other hand, is a nation that has enjoyed long-term fiscal and current account surpluses. Well, that's all for today. For more news and analysis, please log on to our website. Hope to see you tomorrow morning again in another episode of the Business Standard Morning Show, which keeps you updated with the best of business world and beyond. Thank you for watching.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.